the terrorist attacks and the Enron bankruptcy. This is about an hour.
Good afternoon and welcome to the National Press Club. I'm John Aubuchon. I'm senior correspondent for Maryland Public Television and president of the National Press Club. I'd like to welcome club members and their guests in the audience today, as well as those of you watching on C-SPAN or listening to this program on National Public Radio. The video archive of today's luncheon is provided by Connect Live and is available through the National Press Club website at press.org. National Press Club luncheons also are carried live by many sites on the World Wide Web. Press Club members may also access transcripts of our luncheons at our website. Non-members may purchase transcripts, audio, and videotapes by calling 1-888-343-1940. Before introducing our head table, I'd like to remind our members of future speakers. On Thursday, February 14th, the President of Pakistan, General Pervez Musharraf, will discuss Pakistan's future, challenges, and opportunities. Wednesday, February 20th, Gail Norton, Secretary of the U.S. Department of the Interior, will discuss new environmentalism. On Thursday, February 28th, Al Franken, comedian and author, will be at the club. His chosen subject is predatory lending. If you have questions for our, I'm sure he'll address some other things as well. If you have questions for our speaker, please write them on the cards provided at your table. I'll try to ask as many as time permits. I would like now to introduce our head table guests and ask them to stand briefly when their names are called. Please hold your applause until all head table guests are introduced. From your right, my left, Mark Helm, Washington correspondent for Hearst Newspapers. Sarah Hansard, Washington correspondent for Crane's Investment News. Peter Ranjuk, correspondent for Reuters. Patricia Hill, chief economic correspondent for the Washington Times. Ann Sodano, wife of the Speaker. On my immediate right, Ken Esky, former chairman of the National Press Club Speakers Committee. Passing by our speaker for a moment, Ken Dalecki, Deputy Managing Editor for the Kiplinger Washington Editors and the member of the Speakers Committee who arranged today's luncheon. Thank you very much, Ken. Neil Rowland, reporter for Bloomberg News. Beth Belton, online news editor for Business Week. Nancy Dunn, Washington correspondent for Financial Times. Barbara Ream, correspondent for American Banker. Tim Malloy, deputy business editor for United Press International. Salvatore Sodano hasn't had much time for golfing lately. He doesn't have to personally restore confidence in and stability to the equities markets, not by himself. Not that he would shrink from the task, I'm sure. But he does have a critical role in the market's recovery. As chairman and CEO of the Amex, the American Stock Exchange, he leads the nation's third largest stock market and second largest options market. More than half of the American people now own equities, either directly or through mutual funds, 401ks, and other savings instruments. Most investors have seen the value of their accounts shrink, some dramatically, as a result of the burst dot-com bubble and the overall slowing of the U.S. economy in the recession. Confidence was further shaken by the collapse of Enron, once the nation's seventh largest corporation. The September 11th terrorist attacks in New York and Washington only made things worse. Attacks that forced the Amex to briefly close its doors. With hustle and entrepreneurial spirit, the Amex resumed trading on September 17th and returned to its New York quarters on October 1st. That hustle and entrepreneurial spirit has been a Sodano trademark. As the Chief Financial Officer of the National Association of Security Dealers, he was a key member of the team that guided the NASD's acquisition of the Amex in 1998. And as the Amex chief since '99, he has guided it through a renaissance. He re-engineered it around three core businesses: equities, options, and exchange-traded funds. Last summer, he had to lead a quick counterattack against the big board when the New York Stock Exchange began trading in three of the Amex's most popular products. It became, for a time, the Great Q War. The Qs, mimicking the performance of the NASDAQ 100, had accounted for more than 70% of the shares traded on the Amex in the year 2000. And by eliminating fees on those products last summer, Sal Sodano served notice that the big board could not expect to gobble up a market where the Amex had both the advantages of experience and liquidity. Exchange-traded funds, ETFs, have been the Amex's most innovative effort in rebuilding. The Amex also provides an equity market for hundreds of small and mid-sized firms. It's a major forum for options trading. Under Sodano's leadership, Amex has developed cooperative trading arrangements with exchanges in Europe and Asia. He came to the NASD and Amex from executive posts with Westpac Banking Corporation, Price Waterhouse, Morgan Guarantee International Finance Corporation, and Bankers Trust Company. He has a bachelor's degree and a master's degree from Hofstra and is giving back to Hofstra by serving on its endowment, finance, and development committees. He is a native New Yorker. He and his wife, Ann, have two daughters. Please join me in welcoming Salvatore Sodano.
Good afternoon, and thank you very much. I want to thank the National Press Club for the opportunity to be here with you today, and specifically thank you, John, for your invitation. It's quite an honor to be here. I'd like to acknowledge, actually, someone who is here and who I work very closely with in my capacity as Vice Chairman of the NASD. Bob Glauber is here today. I'd like to acknowledge him. Bob is the Chairman and CEO of the NASD. And as Jordan mentioned, also I'd like to acknowledge my wife, Ann, who is here and was kind enough to join me today, and I'm very proud to have her with me this afternoon. Thank you, Ann. Just by way of background, I think it would be worthwhile to take a few minutes to give you a brief background and update on the American Stock Exchange, given that it is really a much different institution than most of you may remember. Our roots actually date back to the turn of the century, when traders would trade securities outside, literally on the streets of lower Manhattan. In fact, we derived our early name from those street traders, becoming known as the New York Curb Market. We moved indoors 80 years ago, and for decades we were primarily an equity stock market listing operating companies. That started changing about 30 years ago when the Amex began to trade options, leading the way for our strong derivative-based product line that we have now at the American Stock Exchange. Today, we are one of the most diversified financial marketplaces in America, and we are the only primary exchange actively trading across three separate product lines: equities, options, and exchange-traded funds, or ETFs as they are commonly known. ETFs are a tradable form of index funds pioneered by the American Stock Exchange back in 1993 with the introduction of the SPDR based upon the S&P 500, and have generally become known as the fastest growing and most innovative products of the last few years. Today there are 119 exchange-traded funds in the marketplace. 117 of these funds are listed on the Amex. We have more than $81 billion in invested assets in a relatively short amount of time. You may know some of these products by their acronyms: Diamonds, iShares, Vipers, the QQQ or Cubes. The QQQ is the ETF that tracks the NASDAQ 100 and is routinely the most heavily traded security in the world on any given day. We're proud to have that listed on the American Stock Exchange. We have been able to leverage our reputation in ETFs to create a global presence for the Amex. In the last year, we reached preliminary agreements to trade Amex-listed ETFs in Europe and in Japan. And in fact, we began trading Amex-listed ETFs in Asia last May through a joint venture with the Singapore Exchange, becoming the first fungible cross-border product traded across time zones. And as regulations may allow, we anticipate that these centers will also become the home of our listed companies if they desire exposure to the capital markets. In short, the new American Stock Exchange has emerged as a strong, viable international competitor. The innovation that led to the Amex trading in Asia is indicative of the new frontier that lies before the capital markets as the global economy becomes more and more interrelated and interdependent. And the lessons we continue to learn about how to navigate the complex and often conflicting regulatory hurdles in pursuing global opportunities illustrates the challenges that the U.S. exchanges face as we work to maintain our leadership position in an incredibly complex, fast-changing global competitive landscape. Before I talk to you about some of my thoughts on the future of the markets, no discussion would be complete without some acknowledgments of the events of September 11th. For us, that day was particularly devastating. Many of you, as John mentioned, know that the American Stock Exchange is located just a few hundred feet from the World Trade Center site. As a result, our building suffered extensive damage when the towers collapsed. On the north side of our building, facing the disaster, we had 7 floors of windows blown out, and offices were heavily damaged by debris from the towers. Because of our proximity to the site, we lost all basic utilities. In addition, the immediate area fell under military restricted zone coverage, virtually eliminating our access to our building. Thanks to our colleagues at the New York and Philadelphia Stock Exchanges who offered us space and support, we were able to get to work right away on restoring our business. I'm proud and, quite frankly, still in awe of the fact that only a few days after the disaster, our Amex employees, working with our NASDAQ, with our technology affiliate, SIAC, and some of our colleagues from the NESD, literally recreated and relocated the American Stock Exchange in 2 different geographic locations, allowing us to resume trading with the rest of the markets on September 17th. More heroism in the face of unbelievable adversity, and another clear example of what America really is capable of. It was obviously an emotional time for all of us, and particularly poignant for us given that we lost 9 of our own members in the disaster, all of whom were having breakfast at Windows on the World in the towers that day. The aftermath of these terrible events have taught us many painful lessons and forced us all to collectively re-examine our readiness and capability to support our mission in the face of unimaginable events. There's no question that we are now better prepared and stronger as a result. Naturally, the effects of September 11th are going to be felt for many, many years to come. And it's only one of the many challenges to the global financial system that we must face. I'd like to spend the remainder of my time with you today identifying some of these challenges and how I believe the markets must respond to them. First, technology has dramatically reshaped the way the global markets operate. No longer are we constrained by methods of communication that only a few years ago seemed like space age, but today have been rendered obsolete by the revolution in information technology. In fact, in terms of a challenge, we find ourselves in somewhat of a peculiar situation. Rather than technology playing catch-up to meet the current needs of business, in the capital markets, our technological capabilities have bumped up against the limitations of our regulatory and jurisdictional framework. Advances in technology mean that we literally have the capability to trade globally 24 hours a day. Yet, the differences in each country's regulatory and accounting requirements render these capabilities, for the most part, unutilized. For instance, the U.S. requirements in terms of corporate governance and disclosure are more rigorous than most jurisdictions in the world. And that's been a critical hallmark in ensuring investor protection. Yet, it also illustrates just how far apart we are on bridging the regulatory and cultural gaps that remain between foreign and U.S. markets as we competitively position ourselves. By way of example, I was in Beijing last May to keynote the Chinese government's annual Beijing International High-Tech Week conference. Like everyone, I was struck with the seminal changes taking place in the development of the Chinese economy in general, and very particularly in the capital markets. An entire economic engine is being built from scratch right before our eyes. Naturally, as a center for capital, we'd like to be part of that, particularly since the vast majority of the emerging companies are small and middle market, what the Chinese refer to as SMEs, the same class of companies that the American Stock Exchange targets. As the Chinese economy grows, and Chinese companies grow with it, they will seek more and more access to the global capital markets, largely because their requirements are weaker than ours. I believe our European competitors in particular will have a distinct advantage in capturing these opportunities as emerging companies seek the benefits of markets that have distinct hallmarks of good corporate governance and integrity while falling short of some of the intense requirements of the U.S. regulatory apparatus. We do need to worry about this. Now, let me be very clear. I want to underscore this. I want to be clear. I am not in any manner suggesting that we compromise the safeguards of our systems, particularly in light of the Enron debacle, which we're all quite familiar with now. Just the opposite. I think everyone here agrees that Enron was a gross abuse of our regulatory system and a complete failure of the check and balance that our accounting system should have provided. Yet, with the world economy at a critical stage of development, we cannot be left on the sidelines as merely an interested party. We need to accelerate our efforts to reach an agreement on a common set of global accounting standards, using our substantial economic leverage to bring the world international standards up to a level that's acceptable to us. If we don't act quickly, significant capital may be displaced from our capital markets, and American investors may miss out on the opportunities to participate in important growth areas in the global economy. Important issues are at decision points. Consolidation to the global markets is accelerating. Clearing and settlement issues are being negotiated. Global listing standards are in development. These are issues which will literally help define how business is done for decades to come. In that respect, our policymakers should use America's powerful economic leverage to help gain consensus in markets around the world to approve universal standards to protect investors while allowing U.S. markets to participate fully. There is no doubt in my mind that the U.S. can clearly lead the way in raising the level of international standards to meet the strictest standards of investor protection and disclosure. I know that Paul Volcker, a former Amex board member, is helping to spearhead an effort in this regard, and I would like to add my voice to those that see this as an urgent milestone, particularly with regard to the competitive position of the capital markets and especially the U.S. exchanges. Well, this task obviously is in good hands. Second, many of the challenges U.S. exchanges face today are caused by a body of laws and regulations that have outlived their intended goals. From our own perspective, we believe that the current regulatory system must be modified to make it more innovative and progressive in order to provide a national market system that is more closely aligned with the 21st century technology. For instance, a competitive gap is widening between primary exchanges, the Amex, the NASDAQ, New York Stock Exchange, which remain subject to long-standing rules, and the emerging electronic trading systems that employ state-of-the-art technology and function under a more flexible and current set of rules. As one of the three primary exchanges in the country, we're guided by rules that were originally formulated by the Securities and Exchange Act of 1934 and which has faced the last major revision back in 1975. Needless to say, a lot has happened since Gerald Ford occupied the Oval Office 30 years ago. That year ago, Microsoft had 3 employees and $16,000 in revenues. All in the Family was the #1 television show in America. You can buy a brand new American Motors Corporation Pacer for $3,295. I think you get the point. A lot has changed since 1975. The desired effect of these changes made in 1975 were to enhance competition in the marketplace, and in a large part they had that effect. However, the massive advances in information technology over the last few decades makes comprehensive change necessary once again. We need to level the playing field amongst the growing number of market centers. Third, the SEC must be given adequate resources to handle the dynamics of a marketplace that changes daily in the face of not only global competition, but a litany of new products, state-of-the-art innovation, and increasingly sophisticated and complex filings. A marketplace works best when competition is encouraged and ideas and concepts move efficiently through the system. Looking down the road, some of the issues facing the SEC this year alone: single stock futures, new exchange registrations, actively managed exchange-traded funds brought to them by the American Stock Exchange, just to name a few. It's obvious that the pipeline is quite full. As I've mentioned, we've reoriented our business at the American Stock Exchange, and as a result, have moved beyond simply acting as a listing venue. We have become a financial marketplace that also spends a significant amount of resources on creating and developing innovative new products. For example, we're now working on the next generation of exchange-traded fund products. As a result of competition and our innovation, the number of annual filings we have alone submitted to the SEC has increased by 131% over the last 5 years alone. The regulatory system needs to keep pace with these important developments, and their ability to do so will go a long way towards determining our ability to respond nimbly and effectively to competitive changes. To that end, Congress has a duty and obligation to provide the SEC with adequate resources and tools to be able to effectively manage the process through the changes that are bearing down on us. And I urge our senators and representatives to heed this call as an urgent priority. While the global economy is rapidly changing, our capital markets, to some degree, live under rules of the old economy. As I mentioned previously, this not only affects our ability to compete with a number of domestic marketplaces, it also threatens the ability of the U.S. capital markets to strategically work in an increasingly interrelated global marketplace. Look at the changes of the last few years alone. China's entrance into the WTO opens up an incredibly lucrative market, one thirsting for investment and capital. In Europe, the creation of the European Union ushered in a unified economy, one that rivals in size and sophistication to that of the United States. The smooth introduction of a common currency, the euro, further strengthened the ability of the EU to aggressively insert itself as a global economic player. In response, the European capital markets have reacted in kind. A combination of the French, Amsterdam, and Brussels stock markets have created Europe's largest exchange, Euronext. Together with the London Stock Exchange and the Deutsche Börse, a powerful trio of capital pools now exists as part of one unified economic zone. Sitting directly in the middle of the U.S. and the Asian time zones, they will be powerful global competitors. In Asia, as I mentioned a minute ago, a new economic engine is in early development in China. And in Japan, although the current economic conditions are weak, the Tokyo Stock Exchange, which lists 70% of the entire market cap of all Asian companies combined, continues to play a leading global role. Further alliances and global consolidation will continue in the years ahead. If you examine the landscape that is emerging, with major global capital centers in the U.S., Europe, and Asia, there's a clear and present danger for the U.S. markets not to be on a level competitive playing field with the rest of the world. I don't want to sound too alarmist. Obviously, significant regulatory hurdles exist in other jurisdictions that will prevent a significant competitive gulf from developing in the short term, but we can't take for granted that those walls won't come down. We need to act sooner rather than later. In the middle of this incredibly fluid global situation, along comes Enron. With the Enron debacle resonating throughout the country, now might not seem the time to ask the government to undertake a major overhaul of security laws and to streamline its processes. Yet, if any lesson at all can be taken from Enron in this regard, it should be that there is far greater danger in maintaining the status quo. Self-regulatory organizations, like the American Stock Exchange, agree that maintaining investor confidence should be the paramount priority. The impact of capital markets of this country, if investor confidence were to significantly erode, would quite simply be disastrous. Billions of dollars of equity invested in our economy would be at risk of withdrawal, undermining the ability to raise capital and keep our economy growing. Any issues that impact investor confidence must be dealt with promptly and boldly. The recent rules announced by the NESD restricting analyst activities and stocks they cover are positive steps in this regard, and we will work with the SEC to do whatever is reasonably necessary to continually improve our oversight. We will not tire in this mission. President Bush's recent proposal to reform 401k requirements to enhance employees' rights is equally important. Assets invested in 401k programs surpassed those invested in traditional pension plans back in 1996, and they've played a significant role in attracting investment and capital formation. More than $1 trillion are invested in 401k programs today, only contributing further to the need to move quickly in light of Enron to ensure investor confidence in the system. Even a hiccup can have significant consequences. SEC Chairman Pitt is moving diligently on these fronts, and in my discussions with him on these and other issues, I am confident that he both understands the significance and the necessity to move definitively and unambiguously. With Enron, the danger we have is that the growing crescendo at the intersection of public policy, scandal, and politics will slow down or even halt the significant changes that need to be made in realigning our laws with our current market situation. I believe we are approaching one of those rare defining moments for the U.S. capital markets. The globalization of the world is no longer a notion, but a reality, and we will need to move nimbly to secure our competitive positions against a growing number of coalescing market forces. As painful as Enron may be for investors and regulators alike, we must not let the current and much-deserved attention on improving corporate standards and regulation freeze the necessary consideration of rules and regulations that will allow the U.S. capital markets to participate meaningfully during a critical period of global economic development. Rather, we should expand our focus to both improve protection for investors and make important systemic changes that are long overdue. Before I conclude, I'd like to provide some insight on what the future may hold for the American Stock Exchange. Since I know we have a lot of good reporters here today, I'm sure you've done your homework and read some articles about the National Association of Securities Dealers may want to sell the American Stock Exchange, so I'd like to deal with that directly here today. For the American Stock Exchange, the practical effect of our ability to meet future competitive challenges will be a change in our own ownership structure. For a moment, I'll speak with my NESD Vice Chairman's hat on. I was Chief Operating Officer at the NESD when we bought the Amex in 1998. At that time, the NESD saw distinct synergies in pairing up with the NASDAQ market with the American Stock Exchange. We also felt that differing market structures within one company would have appeal across a broad range of companies seeking listings in the public market. And I'd actually like to publicly thank the Amex's members and seat owners for keeping an open mind about changing the ownership structure, as well as the NESD for committing time and management resources, as well as financial stability. Both sides took a lot of risk, and I think we are now sharing in the reward of a significantly stronger American Stock Exchange. Since the purchase, the NESD has made a strategic decision to refocus on its core mission as a regulator and, quite frankly, to get out of the business of owning marketplaces. As you know, the NESD completed its separation from the NASDAQ through NASDAQ's private placement. This year, our goal is to determine the specific direction that we will take in guiding the Amex onto its own independence. In fact, at the NESD board meeting a few weeks ago, we formed a committee, co-chaired by Bob Glauber and me, to begin to evaluate our options. It's way too early to say at this point exactly which path we will follow, but we have a variety of options available to us: a merger with a domestic or international exchange, a sale, an IPO, or even potentially a membership buyout or an acquisition, maybe that the Amex gets involved in directly itself. No one option is more likely than any other at this point in time. With that, I'd like to again thank you, John, for your kind invitation. I'd like to express my gratitude to the members of the National Press Club. I absolutely was pleased to be able to do this today, and I look forward to being able to answer some of the questions that we might have here today. Thank you.
Thank you very much. As you can imagine, there are more than a few Enron-related questions on the table. Perhaps the threshold question is, what are the exchanges doing after Enron to require more disclosure of things like contingent liabilities, to require higher, better reporting standards?
The exchanges work with the SEC and take guidance from the SEC with regard to requirements that need to be enhanced existing requirements that need to be reviewed. So we will work with the SEC, who review the requirements of the individual exchanges. So we view it as a participation partnership with the SEC.
But is the Amex in its partnership with the SEC in that regard pressing a particular point of view?
We have no particular specifics that we can point to at this point in time. We'll have open discussion with the SEC on that and a number of other issues on a regular basis.
Let me try asking another way. If you were in charge of the markets, what would you do to avoid other Enron disasters?
Okay. That's a good way to ask it, and that one I can answer. I do believe that there should be a clear distinction between auditing responsibilities and consulting responsibilities by the accounting firms. It is unreasonable for a large accounting firm or any accounting firm to accept significant consulting arrangements or act as the internal auditor of a company with the situation in Enron and also be the firm to opine on their audited financial statements. I think that absolutely needs to be changed. I assume that will be changed, and that would be first up on the agenda to ensure additional investor protection.
It has been suggested, in fact, there's a bill introduced in Congress that company auditors should be appointed by the stock exchanges. What do you think of that?
Well, the biggest issue we look at in terms of improving the job of the accounting profession is to avoid conflict. And people need to also remember that companies who list on exchanges pay fees to those exchanges. Exchanges compete for those listings. If it's the exchange that makes decisions on who the auditor would be for a particular firm, there is a possibility that there could be conflict there, so I don't think that that's really something that I would support.
In your remarks, you called on the U.S. to lead an international effort to reform international accounting standards. A couple of different takes on that. One questioner points to the Bush administration's determination to go its own way on several issues, on Kyoto, on applying the Geneva Convention on the Chemical Weapons Treaty and the like. How can we expect the rest of the world to follow our lead when we are not willing on a range of issues to follow the world's accepted standards?
I think the world recognizes both the degree of capital and liquidity that the U.S. marketplace provides, the level of expertise that we provide around the world, the level of economic support that we provide around the world. Taking all those factors into consideration, I think we do have leverage that we're able to work with our counterparts around the world to bring more and fair disclosure so that U.S. investors are protected in going into the global markets. There is a distinct difference in how the markets outside the United States work, and we need to address those issues, and we have the tools here to be able to bring them closer and get to an acceptable level.
How do current financial reporting standards in Europe and Asia compare with what we have in the United States currently?
Frequency of disclosure differences. The level of detailed disclosure is different. I'll use an example here. Even just within the exchange-traded fund world, we're working here on exchange-traded funds on an actively managed basis. If you compare to what happens in Germany, the German accountants and regulators allow exchange-traded funds to take place where a specialist will have information 30 days ahead of the rest of the marketplace. Now here, people go to jail for that. You just can't, there has to be transparency and open disclosure to all investments. So it could be extreme, there could be similarities in accounting standards. We need to have one similar set of standards where the investor feels that information is transparent and whatever information that he or she needs to make an investment decision is available to them. That's just not the way it is today.
We talked a moment ago about the role of exchanges in reforming accounting standards and about your views, but perhaps more fundamental to the Enron question, do the stock exchanges have a responsibility to the American people on the quality of equity investments?
One of the big benefits of to investors of a company being listed and their shares being traded in a primary exchange, whether it's the New York Stock Exchange, NASDAQ, or the American Stock Exchange, we are under very, very strict requirements in terms of the level of review that an exchange does for operating companies. We have requirements to go through regular review of their financial statements. They need to make minimum standards in terms of financial criteria, audited financials. They need to be open to questioning by the exchanges. So the exchanges provide already a very strong they perform a very strong role in protecting the investor. So there's a function that's already there. To the extent that the SEC and all the other related parties work to enhance requirements, the exchanges will play a stronger role in making sure that the investor is protected.
But is there not, to some degree, a crisis of confidence out in the public on the stock markets when the seventh largest corporation in the country can collapse virtually overnight?
There's no question that an Enron has caused an issue of confidence in the public markets. I view the issue very simply as follows. It's very difficult, or it's not difficult, it's impossible to legislate integrity. And when you get down to the Enron situation, you get down to a massive lack of integrity by the management and many people within Enron. So you just can't legislate integrity. Second, there's already a very strong set of requirements for accountants to do their job. In this situation, the accountants, quite frankly, just did not do their job. So now we need to look at any additional ways that we can force oversight of the accounting profession to make sure that investors are not hurt in a scenario like this again. So yes, there is concern, and we need to do whatever we can to assure investors that every proper protection that should be in the marketplace is there.
Among the many proposals Congress is considering and will consider in the wake of the Enron debacle is one to require 401k investors to diversify. What's your view of that?
Well, diversification is always a good thing for investors in general, not to put too much risk in one particular segment of the marketplace. So we have the debate of balance of a person's right to make a decision and choose with what they'd like to do with their own money against providing diversification so that risk is reduced. My view is that we should provide as much information for individual investors to make proper investment decisions, but I don't think we have the obligation to dictate specifically to investors how they invest their money. The biggest thing we need to do is to address the issues we just talked about before with investor confidence in light of all the issues pertaining to Enron, and make sure that investors are educated properly so they understand all the risks, particularly using the example of diversification. What does that mean and how does that protect them? But I think investors have the ultimate say in what they do in their own investment decisions.
Here's another question that goes to the confidence issue. Are public companies threatened by the multiple roles that banks play as lenders, investment banking, and as investors themselves in equities, in companies?
Well, again, it goes to the basic conflict issue. I don't think companies directly, for the most part, are under extra risk. It's more from the perspective of, let's look at the NESD analyst rules that we've just passed, making sure that the public knows when recommendations are being made by an analyst what their own exposure is to a particular company. What is the policy of that particular company? Do they participate in an IPO? Do they not participate in an IPO? All the new restrictions that are being proposed and by the recent rule. Those are the things which affect our ability for the capital markets to grow and create additional investor confidence, and really is not directly a direct impact to the company itself.
Let's talk a little about the Amex.
Okay.
You talked about a brave new world of in the financial markets that the old regulatory schemes aren't necessarily equipped to handle. Do you foresee a 24/7 market in the future? And talk a little bit about the advantages and disadvantages of that for investors.
The possibility of 24/7 is obviously technically there. We would need to get over the significant regulatory and accounting hurdles. And the opportunity to link marketplaces absolutely does provide advantages to the retail and individual investor in a number of ways. One, it increases pools of liquidity. When you match up liquidity in one country with another country, that provides a better trading environment for shares at any point in time. Second, it opens up investment opportunities for investors anywhere in the world that previously may not have been available to them. So both you open up additional opportunity, you improve the liquidity for those shares to trade. It helps capital formation, similar to what we talked about, or what I talked about earlier in my talk, where the markets are already moving to come together. And we need to make sure that the regulatory environment out there will work to change to allow the United States to more actively participate in that so that we don't fall behind those other markets which are going to move ahead. So it is happening. Technically, it's there. And it does provide a lot of opportunity and additional protection, quite frankly, in the form of additional liquidity.
Well, is the Amex going to have to face the question of converting from the old-fashioned floor specialist to an automated PC-based trading system in that regard?
The American Stock Exchange has seen significant growth in the last 2 years. We are the only exchange that's actually expanded our trading space twice, actually, within the last 2 years. We've expanded it by 1/3 last May. So I don't see the floor-based model moving away. However, what we have been working on at the American Stock Exchange for the past 2 years is a completely new trading environment where we will be replicating in an electronic form 100% of the function that takes place on the floor of the American Stock Exchange today. So what that means is the role of the specialist, the role of the broker, market makers who provide additional liquidity to the American Stock Exchange model has been reduced to a completely electronic version. Now, what does that do? That makes our ability to do business at the American Stock Exchange easier, more cost-effective. It'll be scalable so that growth can be handled very easily. It can accommodate our customers in a number of ways. In addition to that, it provides the Amex with a disaster recovery facility because this is also able to be used on a completely off-floor basis. So we have come up with a completely electronic version of our floor, which we will utilize on the floor. And I use the term at the Amex, once the system is fully in place, we can have virtual silence on the trading floor. No longer will you need to yell or scream across to get market orders or instructions across. Everyone will be interrelated electronically on a 100% basis. But that also gives us the opportunity for traders or market participants to trade with people on the floor of the Amex from Alaska or anywhere you wanted to trade from, so long as they're hooked up. No, we don't believe the floor-based system is going away. We've seen very good growth in the last couple of years, but making sure that we provide for advancement in the marketplace and protect against the future, because no one really knows what the future is going to hold. We have built an environment which will accommodate both.
You know, as an investor or a potential investor, it has become so very easy for me to place a buy order now. I can do it online or on the phone or in moments. But do I have enough information to make a good decision? This goes back to the confidence factor in a way. Can I believe what I read in the annual reports? Is there enough there on which I should be making these orders?
That's a great question. It really depends on the type of security that you're buying. If you get into a very liquidly, very heavily traded security like a Microsoft or General Electric, clearly there's enough information for investors to make decisions. And you could go to the other extreme. Companies that trade on the bulletin board, or the pink sheets as they're called, where there's a limited amount of information available. It really is the responsibility of the investor, and we all need to do the best job we can to continue to educate people, not to just listen to someone else, to do their homework and search and make sure that they understand what it is they're buying. So There are certain instances where securities is more information than you could possibly want, and it's really tough to make a bad decision. And there are other companies or securities where it's very, very difficult to get the information you need to make an educated decision. So we need more and more investor education, and the investor needs to really be aware of the fact that there is a vast difference in what you can or cannot buy in the system that you just mentioned.
Ed Koch used to say, "How am I doing? How's Mayor Bloomberg doing?"
I see the group today really wants to put me on the spot today, but that's okay. Mayor Bloomberg has done a very good job so far. He is already assimilating himself into the constituency of New York. He's a New York person. He has been part of the New York environment through running the Bloomberg business. He's well known. He's smart, and so far we're happy with we're happy with Mike Bloomberg at this point in time.
You mentioned that he's a New Yorker. You, of course, are a native New Yorker, as is your wife. City of New York is very important to you. How do you believe that Lower Manhattan will or should be redeveloped? That's important to the MX, too.
Yes, it is. Lower Manhattan is the financial center of the world, and we need to continue to invest money and develop that as a center of excellence for the city, and it's important for the U.S. economy. The current view is that money will continue to be invested. The governor has put together a committee to make sure that the downtown area is continued to be developed, money invested, and the city and state does a very good job of trying to attract additional investment into Lower Manhattan. Clearly, there's going to be a lot of work to be done. The effects of September 11th have dramatically affected available office space, the psyche of people working downtown, and we're still not fully recovered from that. Many still, are reminded of what happened, on that day. And those are issues we're going to have to deal with. But I'm very confident that New York will remain the financial capital of the world, and we have a bunch of really smart people on the committee that Governor Pataki's put together to make sure that we continue growing Lower Manhattan.
You have any kind of a personal vision, or just anything, any direction that you'd like to see personally, in your view, that redevelopment go?
I'll need to think about that for a second. Actually, I haven't really given much thought to that myself. If you look at Lower Manhattan, it really is a center for the exchanges. You have the New York Stock Exchange, you have the commodities exchanges, the futures exchanges, you have the American Stock Exchange, obviously. And I think it's really important that we all remain in relative proximity to each other. We do speak to each other on a regular basis, and communication is good by telephone, but it's not as good when you're talking with each other for meetings and sharing ideas and looking at ways, whether it's to provide additional investor protection or to talk about ways we can work with each other in enhancing the marketplace, or simply just to communicate and educate each other as to what's happening in the marketplace. So my own view is I hope that we continue to represent Lower Manhattan in particular as the center for financial and the capital markets, and we do everything we can to entice more and more development along those lines.
In a way, I hear you saying that the financial markets and the people who work in it need the kind of synergy that, for example, the World Trade Center provided, the windows on the world provided. Is that an accurate picture?
I think that's an accurate picture. And when you couple that with the fact that all the large investment banks and the Merrill Lynch's and the Goldman Sachs are all resident headquartered downtown in the area, it is just a natural center for generation of new ideas and concepts.
September 11th had a lot of people around the world, and certainly in the United States, thinking and considering personal priorities and lives, but it had to be all the more real to those of you on Wall Street, at or near ground zero. What did it, both to those with whom you work and to you personally, how did this rethinking process go, this personal examination of life?
Well, I think just about anyone would not be honest with themselves if they didn't really take stock as to proper balance in life and what's really important to them. When you see in an instant, in a heartbeat, everything that really you have could be gone. So, you know, I'll use myself as an example, and my wife can tell you without any hesitation, you know, I'd leave my house at before 6 o'clock in the morning and regularly get home, I don't know, 8 to 12 o'clock at night, whether it's dealing with customers or handling business issues. Is that important? Well, yeah, it's very important to the American Stock Exchange that we do whatever we can to make sure we continue to excel and move forward. But that's not really, that's all that's important in life. There needs to be a proper balance between family, between business, and I have adjusted my life. Bob, don't get mad at me for that, but you know, I go home and see my family, and I know many friends have looked at really, and properly so, looked at what's really important, and that's their family. I don't think we should ever lose sight of that.
Do you see more people around you making this kind of re-examination and deciding that it's time to have a life?
Well, there's two ways to look at it. Yes, you need to have a life, but yes, you have to work and work hard so you have a life to live. So, you know, you need the balance there, and getting that balance is not always easy to do. But, you know, life is very precious, as we know, but the business world is incredibly competitive and fierce and does require an immense amount of effort and a constant rethinking and reshaping of how you do things and how you interrelate with your competitors and partners around the world. So it's going to be an art to get the proper balance between making the proper time with those who are important to you and making sure you pay proper attention and do the right thing for all the things you're responsible for.
Well, you mentioned interrelating with your competitors, so here's an opportunity to do a little Amex marketing. This questioner asks, what benefits can companies and their stockholders get from an Amex listing rather than a competing exchange or the NASDAQ?
All right, great. That's a free commercial for the American Stock Exchange, so we appreciate that. Actually, when we first looked at the American Stock Exchange, we looked at the equity market in its current structure, and what we thought was, here is a great opportunity once we put a little more investment in terms of new functions, technology, and services for small and growing companies. We call them middle market companies, to take advantage of the market structure in conjunction with the services that we offer from the American Stock Exchange. Companies that have less actively traded shares out there, it's really important for shares to trade as best as possible within one place. We call it confluence of order flows. So if a company's shares tend to go to one place, and utilizing the American Stock Exchange, we use a specialist system or an auction system, there's one center point of contact. So when those shares are centralized, that provides for greater depth of liquidity. Greater depth of liquidity has a direct impact on stock price. There'll be less price volatility in stock. So as you're growing, we put forward a very strong case and presentation for those new companies to the market and well into mid-cap, that a confluence of order flow through a specialist system has a direct impact on how a company's stock trades. In addition to that, if you compare the American Stock Exchange to, say, a NASDAQ environment is a dealer market, which means that it's a distributed network of traders and market makers who are connected by technology. At the Amex, it's the center person being the specialist. If a CEO or a chief financial officer wants current information, what's happening with their stock, how is it trading, what's happening, we allow CEOs and CFOs of companies, or listed companies, to access the specialist directly on the floor. That's a critical bit of information in terms of market activity that, quite frankly, is just not available anywhere else, whether it's the New York Stock Exchange or NASDAQ. So there's an advantage in terms of being able to get up-to-the-minute information. We've supplemented the basic structure, which we think is good for the target companies that we go after, with services to help them get their message out to the marketplace. We have investor relations services, which are really unparalleled in the exchange world. We help companies understand what it means to navigate Wall Street and the analysts, and even some basic things, such as getting a press release out. Did they cover what they need to cover properly? We provide analyst calls. We have webcasting, where we can get a number of analysts on a call, and a company can present to the analysts what's happening with their company. We help them get their message out to Wall Street and other analysts. In addition, for larger companies, it's not only smaller or mid-sized companies we have on the Amex, we have S&P 500 companies listed on the American Stock Exchange who, quite frankly, are just happy to be on the American Stock Exchange because of the quality of the job we do and the relationships that they enjoy with the American Stock Exchange. So confluence of order flow, investor relations services, information that you could get from dealing with the specialist directly, and proximity of the availability of the staff to listed companies. There's a lot of reasons why you'd want to list on the Amex.
We have time for another question, but first I would like to, on behalf of the National Press Club, present you with this certificate of appreciation for your appearance here today. We greatly appreciate it. Thank you.
Thank you.
And this is the coveted National Press Club mug, which will look good on any Wall Street desk.
Thank you very much.
You talked about the regulatory role of the NASD, and of course in Amex you're creating, building, and maintaining and sustaining markets. Ultimately, what gets your juices flowing more, regulating the markets or building and creating them?
Well, I'll first answer that question with what's important. They're both important. I don't make any distinction about that. Investor protection, regulation, if you're not up to snuff and doing the best job possible, the rest of it doesn't matter. We need to provide the framework where everyone in the marketplace feels very comfortable that there is proper protection and people are looking over the shoulders of people who need to be looked at. And those that do not do the right thing are severely punished. So that's really what's important. So I need to say that up front. Personally, I came up the ranks as a financial guy, a business guy. So that's what my personal interest is. I like the idea of developing new concepts and bringing new ideas to the marketplace. I like the idea of being an agent of change and making things better and more efficient. I think that's what I do best. But regulation is important. We've brought in a world-class regulation guy to help us at the American Stock Exchange. Bob and the NASD regulation provide great example as to how a regulatory function should work. For me personally, it's development of new ideas in business, but regulation is just as important.
Thank you very much, Sal Sodano, Chairman and CEO of the American Stock Exchange. Thank you.
Thank you.
I'd like to thank you for coming today. I'd also like to thank National Press Club staff members Melinda Cook, Pat Nelson, Joanne Booz, Melanie Abdal-Dermott, and Howard Rothman for organizing today's lunch. And thanks to the NPC Library for their research. Thanks.
Thanks. I really appreciate it. Enjoy it.
My pleasure.
Good.
You happy?
Yeah, I'm happy. Guys, a bunch of good questions.
On April 19, 1995, a truck